are in listen-only mode.
Good morning, and thank you for joining us for today's webinar, Changes for Corporations to Consider. We will be getting started shortly, but first, I wanted to take a minute to go over the format of today's webinar. If you are attending this webinar for CPE credit, you must answer the 3 polling questions that are presented during this webinar, along with completing the post-webinar survey that will be sent out with the slides and recording. All phones have been placed on mute for this webinar. If you have any questions throughout, please use the questions tab in the menu. We will address questions at the end of the webinar as time permits. We will also be recording this session, and the recording will be sent out following the webinar. Again, thank you for joining us. At this point, I would like to introduce our presenters. As a tax partner, Pat Connolly has over 28 years of experience in tax accounting, serving a variety of industries, including retail and consumer products, manufacturing, venture capital, and real estate. He provides planning, transaction analysis, and tax compliance services for privately held businesses and their owners. Prior to joining Bloom Shapiro, Pat served as executive director in the business tax services practice of Ernst & Young. He also served as a tax account leader, servicing both privately and publicly held businesses, and as New England Director of Tax Compliance Services. Pat also worked as an agent at the Internal Revenue Service, specializing in employee benefit plans in exempt organizations. In 2014, Pat was named the partner in charge of the tax department in the Quincy, Massachusetts office. As a manager in Bloom Shapiro's tax department, James Benjamin has over 7 years of experience providing tax compliance and tax consulting services. His expertise includes tax return preparation services for business entities, as well as tax planning for significant corporate events. Jim joined Bloom Shapiro in 2017 from Ernst & Young's Transaction Tax Group, where he provided tax due diligence and tax structuring services for private equity investors and strategic buyers. I will now hand it over to Pat Connolly to begin today's presentation.
Good morning, everyone. As Jared noted, I'm a tax partner in the Quincy office of Bloom Shapiro. I will say that I actually have more than 28 years experience. That's somewhat of an old bio. Let's just say I was around for the '86 Tax Reform Act. So I've been down this road before where we had some tax law where there were some pretty significant changes. I think what I remember from back in '86 is that's probably the most significant was all the passive law rules. But I think what was also interesting at that time is that just the whole process on how that law got passed. Certainly, it was a much longer period than certainly these current changes went through. I think with the changes signed by President Trump in December, things moved very, very quickly once things were in motion. I think the proposals were changing daily, and we had to look at those daily. We were getting calls from our clients daily. How would it impact us? So it was really, really quite a hectic time, but we got through it, and now now we need to deal with it. My background, even though I did have a number of years at a Big Four firm, I've always been focused on the middle market, closely held companies. I have done work with public companies. But more companies that are going through the IPO process. So that's my background over the years. James, maybe a little more background.
Yeah, thank you, Pat. So I joined Bloom Shapiro about 11 months ago. Been in public accounting for about 8 years. Prior to joining Bloom, my experience was primarily with larger international accounting firms. And experience was largely split between tax compliance and helping out on the M&A side, due diligence, tax structuring. And I see a lot of that work carrying over even in the middle markets. Clients that are private equity backed or interested in potentially becoming private equity backed or going through a transaction themselves. So I think Pat and I both field questions pretty frequently about clients that are looking to go through a restructuring. So that's kind of my background.
Okay, thanks, James. Just a quick disclaimer. What we would like to cover today is the items noted here. Obviously, the law went through quickly. There still is a lot of guidance that needs to be provided by the IRS on these law changes, and that obviously will take some time. Can't say that we know all the details. I'm not sure anyone does. I think we learn things every day, but I think it's important, at least from what we've seen here, is as we go forward, clients need to be aware of what these changes are and how it might impact them going forward. I think just the whole planning process is very much more involved than maybe it has been recently. So with all that said, let's get started. C corporation items. Easy one, AMT, it's gone after 2017. That's a good thing. I think, unfortunately, it's not gone on the individual side, but at least on the corporate side, it's no longer. My experience is the AMT was a real issue, or could be a real issue, especially for companies that were in a regular tax net operating loss position. Due to limitations for AMT purposes, oftentimes they ended up in AMT. Now that that's no longer an issue. What the law does provide is some ability to recover AMT that may have been paid in prior years. That credit can be refundable going forward, as noted. As far as the corporate tax rate, I think everyone's well aware the rate has dropped from a maximum rate of 35 to 21%. That certainly is a good thing. I would also note that most of these changes in the C corporation area or the corporate area, these changes are permanent, unlike some of the changes or many of the changes in the individual and pass-through side, which do have a sunset. All of these are permanent changes. There is an adjustment on the dividend received deduction. The 80% dividend received deduction has now been changed to 65%, and the 70% DRD has been reduced to 50%. One important item, and I'm sure many of you are already dealing with this, because of the change in the tax rate, that will have financial statement impact on your 2017 financial statements, because those of you who have deferred assets or deferred liabilities, those assets and liabilities need to be remeasured at the 21% tax rate. So I think we've all seen a lot of news out there as far as certain companies getting tremendous benefit or incurring a large expense because of this. So, for example, if you're a company that's, let's say, in an overall net deferred tax liability position, and let's say that's being driven by tax depreciation excessive book in prior years, that under the old law, that deferred tax liability would be measured at a let's say a 35% federal rate. Now that gets measured at a 21% rate, and that will generate a decrease in the deferred tax liability, and the offset to that will be income benefit to the company. Likewise, if you're in a deferred tax asset position, the benefit of that asset will be reduced, and that reduction will come through as expense on the 2017 financial statement. One area where there's been there is some pretty significant changes is in the area of accounting methods. And the changes really involves who is subject to certain types of accounting methods. Oftentimes, that is determined based on an average gross receipt amount. In many cases, in prior years, it was 5 million, or it may have been 10 million, depending on the type of accounting method. What this current law change has done is increased that threshold to 25 million. So it will provide many corporate clients the opportunity to use a different method of accounting. For example, the cash method of accounting. The old rule was if you're 5 million or more for corporations or partnerships with corporate partners, you're required to use the cash method. That's no longer the case. Now you can look at the $25 million threshold, and if you're below that, even if you have a corporate partner, you have the ability to elect the cash method of accounting. Another opportunity is how you account for inventory. Again, this prior threshold was $10 million. That number has been increased to 25 million. And what it does is it really allows a company to reduce the amount of their inventory for tax purposes. The next area, I think one of all of our favorites is dealing with UNICAP. That exemption threshold is also increased to 25 million. So for those below that, where you've been calculating UNICAP, that requirement's no longer there. On the next, on completed contracts, again, the requirement to use a completed contract method, the average annual gross receipt threshold has been increased from 10 to 25 million. Now, what's interesting, most of these, well, these are all considered accounting method changes. So there would be a 3115 filing requirement for these changes. The cash method, the inventory method, UNICAP, those all involved should be 481 adjustments. The long-term contract approach would be a cutoff approach. But again, those provide opportunities to take the benefit in 2018 if you make that method change. Now, what's interesting is, I've given some thought just to accounting methods in general for my clients, and thinking about, are there opportunities even today to make accounting method changes retroactive to 2017? Automatic changes, because if you can generate a benefit in 17, the benefit obviously would be at a much higher tax rate than you might get going forward. So again, this is one of those areas where I think it's just a great planning opportunity for our clients to think about, what can we do even after year end to minimize 2017 taxes. Next area of change, significant change is the change to the expense election. That is now 100% expensing election, and it actually can go back into 2017 depending upon the placed in service date. This expense election, it does decrease going forward. So beginning in years after 2022, it eventually will get to zero as of 2026. There is an election. You can elect 50% in lieu of 100% for 2017 for assets placed in service after 9/27/2017. The the luxury auto limits have increased. An interesting point, if you happen to have an automobile or a vehicle that exceeds the gross vehicle weight of 6,000 pounds, those are not considered luxury auto, subject to the luxury auto limits. And in fact, with the 100% expensing, you have the ability to oftentimes write off in full the cost of a vehicle that's not subject to the luxury auto limits. Next item, and this is an interesting area, qualified improvements. They now have a 15-year recovery period, and the benefit of that is Section 179 eligibility as well as bonus eligibility. What it's done really is expanded the definition of what is a qualified improvement. For example, certain non-residential real property such as roofs, heating systems, ventilation, air conditioning, fire protection, security systems, those items may have been considered 39-year property under prior law. Those now are considered qualified improvements. Now, the issue here, and where there's been a lot of discussion, is do these in fact qualify for bonus depreciation the way the current law is written? There's been a lot of back and forth on this. There's been a lot of information, I think, provided by various firms, because the law, this law change wasn't drafted very well, and there seems to be some concern that, based upon the way the law is drafted, that those qualified improvements may not qualify for bonus, the 100% bonus depreciation, just because of references between the various code sections in the law. So, the question is, what do you do going forward? And I'm not sure I have an answer. There's been some discussion that there might be a technical correction to the law changes to address this, but there might not be. So if you happen to have this particular issue, my suggestion would be is, talk to your consultants and just stay abreast of changes, potential changes in this particular area. And lastly, on fixed assets, the Section 179 expensing election has been increased from $500,000 to $1 million, and again, that's also indexed for inflation. And the phase out of the Section 179, the phase out limit has been increased to $2.5 million. One of the other major changes is the change to 163J on interest expense limitation, and this is an interesting one. My prior experience with 163J was more with the earning stripping provisions, and what you would see is you may have a financing arrangement where the interest may have been paid to a foreign entity, and this was a mechanism to address the tax implications of that, shifting income out of the U.S. to a foreign entity, let's say a low tax entity. Today, or I guess 2018, this limitation, it's completely different. It applies to everyone. And I know I've already had a discussion with one of my clients where it's a pretty significant issue. The good news is, again, you see this $25 million average receipt exemption. So if your average receipts are below $25 million, you don't need to worry about this limitation. If they're above, you do. I'll go through a calculation in a bit, an example, a fairly simplified approach, but it's really, it's based upon a company's EBITDA, and it provides a cap equal to 30% of a business's adjusted taxable income, which again is based on EBITDA. And to the extent that the interest exceeds that limitation, the interest, it's not disallowed, it's just not allowed currently. It's allowed to be carried forward, but certainly subject to the limitations again as it's carried forward. What's interesting on this provision is the add back or the adjustment for depreciation and amortization, that goes away effective, I believe, 2022, James?
Correct, and it becomes EBIT.
Which you think, well, what's that mean? That's not a good thing. What that does is it brings down or will decrease the amount of your adjusted taxable income because you're not increasing it by depreciation and amortization. So the 30% limit will be, in theory, being applied against a lower taxable income base.
So sorry, but that has the effect of a lot of our clients that are maybe manufacturers, they have large CapEx requirements every year. That almost puts them in a worse off position than they were prior to 2018, because as you had mentioned, the earnings stripping rules, that was principally concerned with debt due to a related foreign party, whereas now it's completely different.
Yeah, it's everyone.
It's everyone. Yeah.
Yeah, I mean, I had I had a call one of my clients. It's a private equity owned company, and the company was pretty much fully leveraged as part of a reorganization. The PE firm is concerned because they look at this and think, well, this is going to impact us. And when we did the analysis, it did quite significantly. Their thinking is, can we get around this by looking at what are our receipts? Can our receipts be something other than what we're calling them currently? Because currently their receipts bring them over $25 million. They were saying, well, based on our business, maybe that's not really our receipts. We're a staffing business. Maybe we don't include the gross. Maybe we just include our commission. Getting creative. I'm not sure it works, but those are the type of issues I think we're needing to address.
Maybe just at a high level too. We keep referencing this $25 million rule, and it can be a little bit more complicated than that for trades or businesses that are under common control. And the test can be a broad one, but for now we'll assume common control is 50%. So for a number of our private equity clients, when determining whether or not their portfolio companies are at or around the $25 million gross receipts test, you normally need to look at other portfolio companies that are at least 50% owned by that private equity fund. So a lot of times too, that can create some difficulties in thinking through whether or not we're going to be under that $25 million thresholds.
Sure. I mean, I would suspect that if there's a PE firm involved as an investor with more than 50% ownership, it's going to be an issue.
Yeah.
Yep. Couple of exceptions to this are elections available. First off, floor plan financing for auto dealers is not subject to this limitation. Another area where you see a lot of debt and you see a lot of interest is with real property trades or business. They have the opportunity to make an election not to be subject to this limitation, but in order to make that election, they have to agree to use ADS depreciation for their assets. So that that basically throws out their ability to use bonus depreciation. And then there's just another exemption for certain regulated public utilities or electric co-ops. I don't have any of those clients, but I do have some real estate clients where we will have to address this issue and think about what direction we want to go into. I think what we need to do is we need to just model out their P&L, look at income, look at their interest expense, look at the depreciation. I mean, it's a fair amount of work, and I think it's a fair amount to think about, but it's something that has to be done.
That seems to be the underlying theme with tax reform, between modeling out, the flow-through deduction, whether or not you'd be better off as a C corp, modeling out this EBITDA limitation, modeling out the amount of potential E&P you might have to bring back into the U.S.
Yeah, I mean, I think in my discussions with clients, what I find is it's not one size fits all. So you can't say to a group of clients or group of companies, you'll all benefit, you all will not benefit. I mean, you really have to look at how does this impact my company, or even on the individual side, how does this impact me on an individual basis? It's just, unfortunately, it's not something one size fits all. And I think it's time for poll question 1. Take a minute here. Okay, we're just about ready to close the poll. So I think we're ready to move on. Okay. Just some other business provisions that need to be discussed. As far as net operating losses, the carryback has been eliminated, and carry forwards are now unlimited. I guess the downside is now the NOL deduction is limited to 80% of taxable income. I almost view this as a back-end way to get around the AMT.
Yeah.
But
can't get rid of it.
Yeah, I can't get rid of it. But this one's interesting because the question becomes, well, does that mean that all NOLs now are unlimited? Does it mean that all NOLs are subject to the 80% of taxable income limitation? And it's not the case. What you need to look at is you need to really set up your NOLs. It's almost like you put them in 2 buckets. You have pre-18 NOLs. Pre-18 NOLs are still subject to the 20-year carry forward. They're also not subject to the 80% limitation. And then you need to look at your post-17 NOLs. Those are the NOLs that are unlimited, and those are the NOLs that are subject to the 80% limitation. So, how that gets all done on the tax return, I don't know yet, but it'll be somewhat complicated. So that's something just to note. I had a question this morning from one of our staff. What do I put in the financial statement footnote as far as NOL carry forwards? Because for companies, public companies, you need to show the amount of the carry forward, the expiration. Well, the footnote needs to be expanded. The discussion needs to be expanded. Next item, DPAD, the domestic production deduction, that's been repealed. The next item, and this is an interesting one, amortization of research and experimental expenditures. the prior law, you had the opportunity to either currently expense or to capitalize and amortize over a 60-month period. The new law is for what it says for years beginning after 2021. Those costs, those expenditures must be capitalized and amortized over a 5-year period. No longer have the benefit of currently deducting. That one I think was something not many of us were totally focused on at first, I think just because of the effective date, but just be aware.
I think it'll be interesting to see what happens as we get closer to the date, especially with maybe how the pharmaceuticals are going to react. And you know, it used to be take the deduction for the research you're performing. Now you've got to capitalize it and recover it over 5 years. So maybe if you're like a Biogen or, you know, a larger player in the field, you've got the benefit of a lower U.S. corporate tax rate. But if you're doing a tremendous amount of R&D work every year, you don't get the immediate benefit like you used to. So it'll be interesting to see how that plays out once we get closer to sort of the kickoff date on it.
Yeah, I mean, again, all these changes are permanent in nature, but as permanent can be, I guess.
Yeah.
In the next item, just on like-kind exchanges, there was an ability that applied to real and personal property. Going forward, like-kind exchanges only can be allowed for real property exchanges. Just some other changes. Meals and entertainment. Pretty significant. No deduction for entertainment. That's interesting.
We're gonna have to drill down to those trial balances.
Yeah, I think so. I mean, it was interesting. I had a client meeting to discuss the tax law changes, and it was the Friday before the Patriots playoff game, and the client mentioned he was taking, I think, 50 people to the Patriots game on Sunday, and I said, well, that's nice, but you're not going to be able to deduct it.
Not anymore.
So, but he was a pass-through entity, so I explained to him the benefit of the 20% QBI deduction. So he was not all that unhappy.
That's what's interesting now is whenever we get a trial balance or a P&L, you always see the line entries, meals and entertainment, and maybe it's just something that our controllers, bookkeepers, internal finance people are going to have to sort of stay ahead of just how those entries are being booked. So when their tax people get them, you know, we're not denying deductions for meals or improperly taking deductions for entertainment. And, you know, historically, you know, whatever the balance is, we just take 50%. We don't give it a second thought. But, you know, I guess now depending on how you classify it, it matters. So I don't know internally if you draw a line between what, you know, what's a meal versus what's an entertainment. You know, when you're having office parties, if you need to sort of separate the two for tax purposes, or how you would really look at that, you know, going forward in 18.
Yeah. I mean, I think even if you provide meals to employees on site, there's issues there to be concerned about. So it's a fairly significant change, and some companies could be a large amount.
Well, historically, right, you had an opportunity to get 100% of meals, was it provided on site for the convenience of the employer, and now that's gone, right? So it's they really did away with some of those benefits. Yeah.
So not a good one overall, but you know, something to be aware of. Next item, just self-created property, not a capital asset. I mean, I think this area just it really, I think, puts it in law that it's just clear it's not a capital asset. If you sell it, it's ordinary income. I think this has always been somewhat of an area of contention as to whether you get capital gain treatment or ordinary income. Next item, and this is a new provision, is there's an ability for companies that have a family leave policy to get a tax credit on wages paid under the family leave policy. There's all kinds of requirements that the company needs to make. It's the way I view it, it's similar to having a qualified plan. There's coverage requirements. The compensation has to be for at least a 2-week period. It has to be at least 50% of the normal wage paid. So there's all kinds of rules that if you have this, you can take a look at. The credit's 12.5%. It can be higher depending upon certain situations. Unfortunately, it's only good for 2018 and 2019. But it is a new credit that's out there. Okay. Next, and this is a simple example, but I thought I would cover it. And what we're doing here is we're just looking at the implications, one of the change in tax rates, as well as the impact of the changes to the ability to deduct interest expense. You notice on the schedule there's also a line item for QBI amount. That's for S corps and partnerships and Schedule Cs. That's the 20% pass through. Obviously, doesn't apply to C corporations, but again, as you model, as you plan, it's something to be considered. So in this particular case, we have taxable income under the prior law of $500,000, which is simply taxable income before interest expense less the interest expense, taxed at the old tax rates, generates a tax of $170,000. Under the tax law changes in 2018, you first need to look at how much of the interest expense is deductible. So in this case, taxable income before interest expense is $1 million. There needs to be an add back of $400,000 to that amount to give you $1.4 million. The $1.4 million, you apply a 30% rate against that amount, and that gives you the interest expense limitation that we have here of $420,000, which means the previously calculated under 17 law taxable income of $500,000 now becomes $580,000. But at a 21% tax rate, there's still a tax savings of $48,200 compared to the prior year. Just a comment, you may have a question about W-2 wages. Why is that shown here? Again, that's part of the qualified business income calculation and how that's calculated and limitations that might apply. Again, it's not a C corp issue. What we will talk just a little bit about, and we'll just touch on it briefly because we do have a session next week, a more detailed schedule session to discuss international taxation, but I do want to bring up a couple highlights. I think as most everyone knows, the U.S. is changed to a territorial tax system. I guess modified, I guess is probably the best way to say it. I'm not sure it's pure territorial tax system, but it is certainly more of a territorial tax system. It wasn't how it worked prior to 18. The U.S. had a system where taxation was based on worldwide income. Under this system, going forward, 2018, there is 100% dividend received deduction for foreign dividends received by a U.S. corporation from a foreign subsidiary. It is important to note that if you're an S corporation that has a foreign subsidiary, the dividend received deduction does not apply to S corporations. Now, and I'm sure some of you are having to deal with this currently, as part of this change to a territorial tax system, the law is requiring the repatriation of accumulated earnings going back to 1986. So there's a one-time charge on those earnings, and those earnings need to be brought back in 2017. The challenge here is, at least based on my experience, is typically, a company may have taken the position that these foreign earnings were permanent in nature and may have not done as detailed an earnings and profit analysis as you might expect or might be required to do under the current changes. So for many companies, this may take a fair amount of effort to calculate what exactly this toll charge is. Because, again, getting back to the financial statement impact, it will impact the financial statement, and it'll need to be disclosures on this. I think FASB and the SEC recognizes that for some companies this could be a real challenge. So there is some guidance out there as to what you might do if you happen to be in that situation. So look to the FASB and SEC guidance, because it does provide for some estimating of what that toll charge might be. The good news is there is also an ability, once that tax is calculated, that you can pay it out over an 8-year period. The tax, it is at a reduced rate to the extent that the accumulated earnings is in cash. That rate is 15.5%. To the extent it is in other illiquid assets, that rate is 8%. As I mentioned, there'll be certainly more discussion on this next week if you happen to be attending next week's international webinar. What I'd also like to address is there's certainly state and local tax implications from all of these changes. The issue here, as you see, is each state, how they follow federal. There's typically state laws that mention or tie the particular Internal Revenue Code that the state will follow. So, some states, I know in Massachusetts, for example, or for individuals, the individuals follow the Internal Revenue Code as of 2005. On the corporate side, it's tied to the current code, but there's some exceptions to that. But it really does vary state by state by state. So again, how tax reform impacts even your state deferreds. It's something that you need to think about. And I think I know I've seen some communication, I believe, from the Mass Society to the state DOR and state legislators, bringing them up to speed and needing to have an awareness of what the impact will be to budgets, for example. Just an example here, just mentioning a couple of the local New England states, Connecticut, Massachusetts, Rhode Island. They all have a rolling adoption conformity, which means they're tied into the current year Internal Revenue Code. Poll question 2. Okay, I think we've closed the polling question. We'll move on to the next topic. Just when you look at the calculation of state taxable income, oftentimes it starts with federal taxable income. So just be aware of that. The individual side, you know, it's probably more complicated, but on the corporate side, you know, it's generally is it pre or post NOL. Again, that varies by state. Again, another example of what the impact is in the reduction of the federal rate to 21%. You know, the impact to what are the effective overall rates, including the state rates. As you can see here, that it's a pretty considerable decrease. I mean, obviously, it's more complicated for a company that is in multi-states. You know, certainly the state effective tax rate is more complex. But I think, you know, the bottom line is obviously the federal benefit is pretty significant. Next item, just following up on the international side, and again, more discussion next week, but looking at the federal change and the repatriation, what's that mean for state tax purposes? And again, as you might expect, it varies by state. We've got listed here just the Connecticut, Massachusetts, Rhode Island, how that repatriation would be taxed in a particular state. And the question here is noted is, will there be the ability for an 8-year payout for state tax purposes? I've not seen anything legislated yet, but that's something to watch as we go forward. Next section, this is, again, just an example how the dividend received deduction for federal and state purposes can be different. And again, it varies by state. You know, the changes to the federal side, it doesn't necessarily follow, states don't follow that. Next, unitary state treatment. You know, this is interesting. You know, how does the impact with the territorial system now, the federal, you know, the unitary state rules could be very, very different. I mean, they were very, very different prior to the change, or potentially could be. I think they'll probably continue to be complicated going forward. You know, has the entity made a water Z election? Is it, you know, depending on the state, you know, what's the requirement? Who gets included? Who doesn't get included? Who can you elect in? Who can you elect out? All of that, you know, you need to really, really focus on the state tax rules for that. Next section is the 163J limitation. Again, because of conformity with the federal code changes, it follows federal. For some states, you also need to be aware that there could be some related party adjustments that are unique to that particular state. Again, Connecticut and Massachusetts has that. Poll question 3. Just want to mention that if anyone has any questions, certainly feel free to submit those online. I'm not sure how much time we'll have today to address them, but certainly if there's anything about lunch, we would follow up. Again, continue on with some of the state issues. The 80% limitation, because every state really has their own set of NOL rules. The 80% limitation doesn't apply. It's interesting there. You could have going forward, federal and state differences just because of limitation. Bonus depreciation. Most states today are decoupled from the bonus. That I expect will continue, but most states generally follow the federal rules as far as the 179 expense election, and I expect that would continue. The domestic production deduction, again, for most states, it wasn't allowed currently, so obviously no impact. Now, one last question, one last issue I've come across. The question now comes up for many of our clients is, now that the corporate rate is 21%, and I'm an S corporation, should I convert to a C corp? I've had that discussion already with some clients. What we believe, in general, that even with the reduced tax rate, there's probably not a good reason to convert to C corp from S corp. With the qualified business deduction, if you qualify, as well as still having the issue of double tax with C corporations. If you model the numbers out, it just probably doesn't make sense to convert. But again, this is an area, we had a client, James and I had a client meeting just recently where it was interesting. There was a private equity investor. The company redeemed out the private equity investors, redeemed them out through financing for much of it. The owner would like to pay down that financing as quickly as possible. Obviously, the 21% rate allows him to retain more of his cash to give him the ability to do that. So on the short term, the company made a decision to stay as a C corp and then revisit the conversion once the debt gets paid down further. So I don't know, how much discussion people are having with their clients on this, but it certainly, I think the question does come up. It has come up quite frequently.
Right. I think where we see it the most is where you have a shareholder. They can be a shareholder of an S corporation or a C corporation that has a very high effective individual tax rate, and earnings from that S corp would be subject to that high effective individual income tax rate. And the question comes up: would we be better off as a C corporation, right, if we're subject to a 21% rate? And I think it depends on the client. But if you have an opportunity to redeploy that capital in your business, so you don't need it as a dividend, it may very well make sense to operate your business as a C corp going forward. And that's sort of the situations where we've recommended as a client says to us, we don't need the dividends. We prefer to keep the money in the business. And ancillary to that, maybe you get into discussions as what's reasonable compensation, because that's really the other avenue. If you're going to take money out of your business as a shareholder, is what are you taking for salaries now? How does that compare to the revenue and the income that your business is throwing off? And if we're no longer going to rely on dividends, can we up that compensation number without there being any concern that it may be classified as unreasonable compensation and recharacterized by the service as a dividend? So to Pat's earlier point, I think we've really done a lot of work in Excel trying to at least model out at a high level, how this is going to impact our clients.
Yeah, I mean, I think, my experience, back in the 80s, the big thing was the passive loss changes. That was huge, a lot of discussion, a lot of planning. I think the way I view the current changes is this pass-through entity qualified business income matter. I think that's where there's going to be a lot of discussion and planning and creativity, I guess, as we go forward.
That's what's interesting is they haven't published Treasury regulations around this 199A deduction. We don't have much in the way of really interpretation other than what's been codified at this point.
Yeah, and it could be quite a while before we see any guidance.
Any guidance, exactly.
Yeah. So interesting times. I think we don't have any questions submitted online, or do we have a couple? No, I don't think we have any. So I think we're good. I think we're right at 12 o'clock, right? Pretty close to it. All right. So thanks, everyone. Certainly appreciate the opportunity to speak with you on this webinar, and good luck in your planning going forward.